Good afternoon. This is Craig Modelmog for another episode of Wall Street X's and O's. Today is Wednesday. It is Wednesday, isn't it? You know, they always say, when you're getting old because time just flies. I would say it flies regardless. Yeah, today is Wednesday, May 27th. We are almost about through the month of May. It's hard to believe. I will kick things off by saying that the opinions and views on my show are mine. They are not to be received as a solicitation to buy and or sell any investments. Also, investments do have risk of loss of principal. That is a given. And what the goal is for this show is to really focus on facts and help you all become better investors. That's really my underlying reason. So anyway, as we get going here, welcome. Tanya's next door working on continuing ed. I had to laugh. She goes, "Hey, have you done it?" I'm like, "I did." She was like, "When did you do it?" I'm like, 3 weeks ago. Where were you? It's on our best interest contract. So we actually have a new regulatory requirement where we have an ADV Part 2A and 2B. Now we are going to have a Part 3. So you got to love that, It's just always a fun day in paradise, let me tell you. But hey, to kick things off here today, after a very protracted sell-off and huge rally off our March lows, the debate between stock market bulls and bears is really heating up. It's getting kind of fun. It's getting great to watch. You're starting to see lots of more people kind of lean to the side of this is going to be a V recovery. But, to me, I think it's very clear that we're going to be facing the fallout relative to insolvency, bankruptcy, and delinquency. And I'm going to start there. Insolvency. What is insolvency? It's the state of being unable to pay the money owed. Here's the problem we're seeing a lot of companies have, is that because they are either not selling something or because their customers are not selling anything to pay them, if you are a supplier, all of a sudden companies become insolvent. What we've seen here in the last 4 to 6 weeks is you've seen companies float a lot of debt, more bonds, okay? Some of it has been to take down old debt and refinance old debt at lower interest rates. Others have been taking down debt to stockpile cash. During times of severe uncertainty, cash really does become king. And I think we're seeing that now. So the insolvency component, I think, is huge because it's not a liquidity problem. The federal government has done an exceptional job up to this point of creating liquidity. In fact, to date, in 8 weeks, the Federal Reserve has created more liquidity than they did in all of the financial crisis. I'm going to say that one more time. They have created more liquidity in 8 weeks than what they did during the entire financial crisis. That's a big deal, That's 8 weeks of really getting after it, rolling up the sleeves. They've done a great job there. The problem is liquidity does not solve insolvency. Or that's the problem at hand here, So keep your eyes on that. Next is bankruptcy. And this is interesting here. Here's a list. This is from Business Insider. Here's some really big time, not big time, but their names you're going to recognize is from a standpoint of bankruptcy. Tuesday morning, they filed today. They filed for Chapter 11, closing approximately 230 stores. J.C. Penney, shocker, not. They filed for bankruptcy. They are filing for Chapter 11. They are also closing about 30% of their stores. Garden Fresh restaurants. They are owners of buffet chains. Shocker there. But who's been to a buffet in the last 10 years? Not me, unless you were in Vegas, and that's kind of different because you can go gamble, have a few cocktails, and pig out. But anyway, who goes to buffets anymore? They are filing for Chapter 7. You know what Chapter 7 means? Later. They're done. They're closing their doors forever. Stage stores. You've heard of the Stage. They own Goodies, Palace Royal, Beals, Pebbles, Gordman's. They filed for Chapter 11. Neiman Marcus, High Dollar, not really working too good for them. They're filing for Chapter 11. J. Crew filed for Chapter 11. True Religion, another retailer, filed for Chapter 11. Who else here? Food First Global Restaurants. Never heard of them. Bummer. Moving on here. Modell Sporting Goods. I've heard Dick's is struggling. That's kind of interesting. And the list goes on. This is real deal, okay? The next thing I'm going to fly over to is delinquencies. Here's some interesting thing. Mortgage delinquencies saw their largest money increase ever, okay? Ever is like using the word guaranteed in this business. Whenever you hear the term in quotations, it's the worst ever. It's the best ever. You should tune in and really listen, okay? So mortgage delinquencies saw their largest monthly increase ever in April, doubling from 3.4 to 6.5%. So 6.5% of all mortgages in the United States are delinquent. If you go to, that's actually I'm reading my notes here. Actually, 9% of mortgages. So the increase doubled, but 9% of mortgages are currently, that's an addition too. So we got 6.5% are in delinquency, then we got 9% of all mortgages are in forbearance. That's interesting. Another great stat, 15 million credit card owners are in forbearance, meaning they're not paying their credit card debts, and also 3 million auto loans. Yikes. That's what my son CJ would say, which cracks me up. Whenever he wants to be sarcastic, he uses the term yikes. That's like in Scooby-Doo where they would say jinkies. I know, it's crazy, and I digress. So anyway, serious stuff when you really think about insolvency, bankruptcies, and delinquencies, okay? Moving on, but it's because of that where I really am very amazed that Wall Street is still hung up on this V-shaped recovery. You remember my last one, I was doing hand signals on all the different shapes and stuff. The V-shaped deal is real, and I'm troubled with it. Here's some more stats. Consider this. Historically, there's never been an instance where initial claims, and these are jobless claims, have increased by more than 100,000, where consumption didn't slow for the corresponding quarter. That means the quarter that it's happening, and further slowdown. See, now I lost my place. And further slowdown over subsequent quarters, plural. That means quarters in advance. Okay, let's talk unemployment. In 60 days, we have lost 40 million jobs. Okay, initial claims rose by 2.4 million last week, bringing the cumulative 9-week total to 38.64 million. The PUA claims, what is PUA? PUA is Pandemic Unemployment Assistance. It's part of the CARES Act, and it really covered workers who were ineligible for traditional state unemployment assistance. So those were independent contractors, self-employed individuals, and others that were detailed within the CARES Act. You saw the PUA claims increase by 6.2 million individuals, okay? Continued claims, these are people that just didn't file for 1 week. They are continuing to file. They increased by 2.53 million last week, with a total of 25.07 million people continuing to file for unemployment. What's this mean? Here's what I think is going to be coming. Whoever's heard of the PPP, okay, the PPP was a government program here recently, or government backstop for business owners or businesses, where it gave them the ability to continue to keep people employed and use these funds. If you use 75% of the funds to cover payroll, you could do the extra with mortgage expenses, or not mortgage, but your leasing expenses, anything business related. It covered you for basically 2.5 months, okay? The first round of those is going to be coming up here starting in June. Again, quick review, it is May 27th. That is quickly approaching. Here is Craig's prediction. Businesses, because we are just starting to get back to work, just starting, okay? We're on the front end of this. My prediction is we're going to see another round of more layoffs, because what business owners are going to do is they're going to say, you know what, I had this government assistance. I didn't lay people off. I kept them on my payroll, and I was paying this with this government assistance that I now do not have to pay back. Okay. Now that this is exhausted and I'm looking at my business, a lot of the business owners that I talk to are like, you know what? I'm laying these people off because I can't afford to pay them. Why? I do not have the capacity nor the revenue to keep them on board. And that goes across a variety of different industries. So I think we're going to see another uptick on unemployment, okay, which doesn't bode well for the economy. And that's where, when I look at what's happening, I think what the market is doing, I think it's building in all this go back to work stuff. It prices it in advance. Again, the market's kind of a forward-looking device, and I think the market's really already pricing in going back to work. I think they are overdoing it a bit. Because, again, like I mentioned before, when you shut things down for 8 weeks, which is as long as some of these businesses have been closed, it's not like turning the light switch on, okay? I talk to lots of business owners, again, like I said, who are going, look, I have X number of employees, and when I go to turn the lights back on, there's a good chance I'm only bringing 25% of them back, 30% of them back, because I don't have the business to cover that expense from a payroll standpoint. So I think the market may be overestimating this turning back on. I'm actually calling it a re-risking type of situation as I set my notes up here versus anything. So getting into a couple points here before I close out here. I'm not going to ramble on for like 18 minutes like I usually do. Bear market timing. Bear markets do not end at the first sign of a Fed bailout. Typically it lasts on average for a median, which is middle, of 20 months and 18 months respectively. So, or the average is 20 months, the median, which is the middle, is 18 months. We are just 3 months into this deal, and we've got more than 40 million people who have lost their jobs. That really doesn't bode well, okay? Q2 earnings are really going to be ugly, because if you look at Q1 earnings, which, to give you an idea, and this is as of yesterday, 480 of the 500 S&P 500 companies have reported. Sales growth was up for the quarter only 1.02%. Earnings growth for the quarter was down minus 7.71, okay? You've got some really challenging things that are going on out there, and earnings are just really not very good. Thus far into this year, you usually start to see the development of a collapse from an earnings standpoint, where, to give you some context here, Q1 we were down 5% from a standpoint of looking at degrees of deterioration from peak to the trough of end of Q1. On average, historically, it's down 15%. During the financial crisis, we were down 40. That's a big number. Wow, I'm looking at that right now. That's a really big number. So, again, looking at the numbers, okay, looking at the facts, you know I'm big on the facts. I don't want people to get ahead of themselves here, okay? This market snapback has been fine. As I told you the past couple episodes, I've used this to kind of re-risk or de-risk portfolios. It's not a time to add risk, okay? I read an article this weekend how, because there's no sports betting, you've got a significant number of people now that are playing the stock market. And I use playing not lightly, okay? We're seeing that in trades, because they're able to track trades, and they look at trade sizes, where people like us will buy in, 50, 100 share, 200 share lots, versus institutions are buying thousands. So they can track this. So they really are seeing this uptick in lots of small purchasers, which would lead me to believe that that could be possibly a piece of this. But going forward's another thing. When you look at what has been big performers here, it's all of the areas of the market that are what I would call high risk. So, for instance, you've got the high debt to the enterprise value. So these are just high debt laden companies. Year to date down excess of 20%. For the week ending last week, up 6.7%. High short interest. These are companies where you've got hedge funds and people that are trying to short the stock because they think it's crappy and it's going to go down. Year to date down 23%. Last week up almost 7%. You've got high beta stocks. High beta means higher risk relatively speaking, to the markets. High beta stocks year to date are down 32%. Last week we're up 9.5%. You look at those numbers in itself, and what has really driven this rally has been a lot of the areas that really got oversold due to they should have been. And now you've got all this money piling into the high risk areas of the market. You've got tech still leading. Interesting fun fact for you. In the tech index, you have two stocks that make up 40% of that index. Apple and what's the other one? Apple and Google, maybe? I think it's Apple and Google. It's crazy. So, or Apple and Microsoft, that's what they are. So you're seeing very narrow participation, which is also another thing to really keep your eyes on that, because there's not a lot of stability there. To close out here, I'm going to throw some more stats at you from my week. I think a lot of people put a lot of emphasis on hope. I hope they find a vaccine. I hope things work. Well, to be honest, I read this. Hope has never been a good investment strategy. Just good food for thought. At this point in time, 1/4 of the entire working population is unemployed. If you look back at the not the financial crisis, but the tech wreck, 2000, 2001, and 2002, from March to May, the market was up 35%. This is post first sell-off, okay? What's interesting is after that rally is when most people lost their jobs. So you usually see a bounce, a bear market bounce, and we'll go down, may not retest the bottom, could break down and go to lower lows. It may not go down, but it may set a higher low. We have not seen that yet. That is historically what we can anticipate. When I look at this reopening process, as I mentioned at the beginning of this, I really view this as a re-risking. While we may be unscathed or we may not see a lot of new cases this summer, I think as we get into flu season, fall, late fall, I think we're going to see things potentially ramp up again. Okay, and it's something to not take lightly, particularly with all of the leverage in the system. Looking at vaccine, I mean, what kicked off our week on Tuesday was there was another biotech company that was starting a phase 1 trial of a vaccine. Vaccines take time to be developed, okay? Normally, I think one of the quicker ones or quickest time frames is about 4 years. Now, I know they are going to be able to rapidly move through the red tape, but they still have to execute prudent precautions as they test the safety of the vaccine. This is not going to happen overnight, okay? So the vaccine fluff in the markets, again, it's fluff, and I just don't think it's something that we buy, okay? In closing, here, and yes, I'm putting my mask on again to drive home my point here. Although, you know how I wear my mask? I wear my mask like this. Tanya last thing goes, "You're stretching out your mask." I'm like, no, it sucks. I hate wearing it. So I put it on the bottom. Although now I feel like I'm 16 because I get zits all over my chin, which, not to digress once again, but it's ridiculous. So anyway, here's the deal, and I'm going to take this off. I want people to be safe, okay? I know I'm as tired of this as you are. But you know what? Regardless of how bad this is or not, I think we're learning a lot more about this COVID virus. What I want to encourage you is to be smart, okay? Exercise good processes to protect yourself. If you are one of those high-risk individuals, you need to be careful, okay? For those of us that are not in those high-risk areas, we need to be smart and respectful of other people that may be in those high-risk areas that we may not know or be coming into contact with. So you know what? I know wearing your mask sucks, but you know what? Do it. Not for yourself, do it for other people, okay? Whether it works or not is not the argument here. What the argument is you know what? Let's be smart. Let's be caring for others, which is something that people say, you can't tell us what to do. That's BS. Just because we have freedoms in this country doesn't mean we exercise them. Sometimes we need to be thoughtful of other people and do the right thing versus what I have a right to do, okay? People get mixed up on that crap and it freaking kills me, to be honest with you. But anyway, in closing here, I tell you what, it's always great to see you all. I feel like things are settling in business-wise. You know what? We continue to keep our heads down. We continue to stay focused on quality. We continue to stay focused on making sure that we are managing risk as well as we can. That's what I would encourage you all to do. So to sign out here, today is Wednesday, May 27th, and this is Craig Modelmog for another, and I went over again, it's almost 20 minutes. I'm sorry, I just can't help it. It's just relaying, again, it's good information. You guys need this information because information and facts are important because that's what we base our decisions off of. Anyway, for Wednesday, May 27th, this is Craig Modelmog with Wall Street X's and O's, and I am out.